to this special Diwali Samavat series. Our guests today are Sunil Singhania and Sailesh Raj Bhan of Reliance Mutual Fund. If you got money into your flexi cap fund or into your pure equity fund, say 100 rupees, how would the split be sectorally?
Okay, like I mentioned, this time we are seeing growth across many sectors in the market, right? It's unlike last year where you just have 2 or 3 sectors delivering. The good part is after a phase of correction, even in those sectors which have done well earlier, the consumer and all that valuations, they are becoming now rational. They are not very cheap, but they're still rational. When we are seeing a broad-based GDP and economic growth recovery in India, you will find value emerging across sectors. So maybe today, given the global growth scenario, the global sectors might be a little bit muted to buy, but I think domestic growth recovery as it accelerates and we get along with the next 2 or 3 quarters will present a lot of opportunity. We are overweight on engineering, product engineering businesses in India. I think that is a sector which continues to be good. And we think the growth recovery in these spaces, that particular space will surprise. Pharma continues to be steady. We are comfortable with allocating both in domestic and international pharma companies. And the other banking continues to, at least the public sector bank space, the top tier banks are continuing to come back in terms of better operating performances and lower costs. And as asset quality improves over a period of time, I think that space will also benefit. Private sector banks, I think the top tier banks are doing well, gaining retail market share, having strong CASA and stuff like that. And as a broad-based recovery happens, these will be one of the meaningful beneficiaries of that. So these 4 or 5 sectors, including auto, would be there. If you look at theme-wise, I would want you to evaluate theme-wise, urban discretionary recovery, I think would be the first starting point for this, because that was where the sentiment had hit the worst last year. And I think when you have a recovery there, whether it's auto, whether it is organized retail, whether it is, these kind of areas, you'll find a recovery which is faster. Actually, that's interesting because even Ambit was talking about the same theme a couple of weeks ago. Home improvement, urban recovery, etc. But, Sunil, I just wanted your viewpoint because I think you have your ear to the ground more than anyone else we know. In terms of what the retail investor sentiment is now, have you seen retail demand pick up a lot compared to what it was, say, 6 to 8 months ago?
No, definitely. I think, earlier when you used to go for investor forums, the number of people who used to attend then, and this is 6 months back and now, it's completely big change. Okay. And as I said earlier, this last 1 year return has shown the investor that even the last, before that 2-3 years of challenges also made up I1 return. So the index has gone up by 25-30%, but funds have gone up by like 50 to 70% in the last 1 year. And I think that is what investors are looking at. Having said that, I think investors are now much more rational also. So the days of investors expecting 100% return in 6 months are now behind. Investors are looking at steady, good 15-18% return. And more so because the alternative investment avenues like real estate, gold are not doing too much. And in fixed income also, after the recent changes in taxation, on a post-tax basis is not as attractive as maybe equity is. So I think across a feel-good factor, equity markets doing well, on a post-tax basis equity becoming much more efficient, and big under-investment in equities. I think all this is leading to investors moving towards equity. In fact, one of the funds which we did just 15 days back, we had almost 50,000 investors invest in it. So I think it clearly shows that now investors, even on not only HNIs, but to some extent even the retail, is looking at equities.
Well, we have seen a continuous selling by FIIs entirely the month of October. About $500 million have been pulled out, but DIIs have come in. Do you think this trend is likely to remain now, that there is sufficient faith among the domestic investors in the Indian market that we shouldn't worry about temporary pull-out of FIIs?
Domestic investors started to come in seriously and meaningfully. The allocations still are very, very low, but I think on month we are finding the interest going up substantially. So it is a good counterbalance to the only unidirectional flow which used to be there in the last 3-4 years, which was FII driven. So I think it's a good case that there are opportunities for Indian investors to participate, and they are seeing this as an opportunity. And we think this balances out a lot of volatility and
Okay, so you want to leave us with one Diwali gift for our viewers, a top stock idea, top sector idea? I'm just trying my luck.
I think Sailesh already mentioned about the urban discretionary theme. I think that's a very, very strong theme. We believe that there are other small themes. Lata mentioned about home discretionary. I think that we've been playing for the last 1 year. But beyond that, I think homegrown brands, which is still a small theme, can develop into a larger theme, you know, because now the avenues of sort of selling have improved or increased manifold.
So what are the stocks we're looking at there?
You can see some of them in our portfolios.
No, avenues of selling. Actually, I wanted just to complete with that theme. Just up until 3-4 days back, or maybe a week back, we were so much all engrossed in the digital theme when Alibaba listed. Is that a big sector that you would look out for? Not digital or online sellers, there aren't so many of them perhaps, but all those transportation stocks, logistics stocks. Is this a very big story?
The sector is going to be large over the next few years, but the winners are not clear. So today people are investing in what is available. So are these the right businesses to own where ROEs will come over the next 5-6 years? You know, it's a little bit early in the space. But the space will be large, and clearly India is a tipping point in terms of that particular sector. Likewise, there are many emerging sectors in India, whether it is your sector of media and entertainment or, you know, organized retail itself. All of these are very, very small in India today, and you'll have growth along comparable levels and meaningful levels in each of these areas over the next few years.
You're giving us personally a Diwali gift by saying media would do well. No, but leave us with some numbers. I mean, you spoke about, say, a 3-year rally in equities. What is the kind of percentage or number you are looking at for the Nifty or the Sensex?
I'll give you.
And in that period, say in the next 1 year, will mid-caps be outperformed?
I'll give you a roundabout answer. You know, if you just go back 2002 to 2008, Sensex earnings tripled. You know, they went up from like 250 to 800, and the index went up by 6 times. Okay. Between 2008 to 14, ex-IT and pharma, Sensex earnings did not go anywhere, and the markets did nothing. Our view is that between 2014 to 2020, the earnings will triple. So, you know, you can basically take a call.
That would mean 6 times. That's what
I don't know. You know, I'm just giving you history, and I'm giving you our expectation of earnings. See, earnings expectation, we can try. Obviously, no one goes right. Even earnings expectation, you see the carnage in TCS and HCL today. But, you know, at least you have a view that this is possible. So from 1340 or 1350, which earnings were at FY14, we can look at a sort of a, you know, sort of a bull case scenario of 4,000 for the Sensex earnings by 2020.
And what about the mid-cap index?
So that's Sailesh, since you are the flexi-cap guy, you tell us, in the next 1 year, will the gains in mid-cap be double that of gains in Nifty, for instance?
I wish I knew. I think the good part is, you know, you've seen a mid-cap rally happening. You've seen one good phase already happening in the last 6-12 months. Like at the start, as I talked about, overall market itself across the board is reasonable. You know, it's not exorbitantly priced or exorbitant value. Even large caps are reasonably priced to that extent. So we may have, you know, a possibility of benefit in both the spaces. Now, will in a 12-month period, the mid-cap space will do disproportionately. It's a function of how much of growth returns. If growth returns very fast, normally you will find companies with lower bases growing faster. So that's the case. If you have an expectation that growth recovery is very, very fast and very early in the system, your call might be good.
Sunil, Sailesh, on that note, we have to wrap up the show. Thank you very much for joining us with your Diwali advice and your Diwali greetings for our viewers. We wind up this edition of our Diwali Samavat special series on that note, but there's lots more in store for you this Diwali season.